Hello everyone and welcome to this webinar. My name is Lucy Moore and I'm a Professional Education Manager at ACCA. Our session today is designed to support your preparation for the Taxation UK exam, focusing on the syllabus changes related to the new Finance Act. And I'm very pleased to be joined by an expert tutor, Aileen Edgar. Aileen has 12 years of really broad accounting education experience for professional accounting bodies as a lecturer, writer, reviewer and examiner. As well as running courses with some online tuition providers, Aileen is an accounting and finance tutor for several universities on their business degrees and MBA programmes. And she's also been a subject matter expert for BPP and Kaplan for many years, updating learning materials and creating online lectures. So in this session, Aileen's going to take you through the key syllabus changes related to the new Finance Act, which will be particularly important if you've attempted this exam previously under the older syllabus. And she's going to bring those changes to life by showing you a couple of examples of how some of the affected areas could potentially be examined. She's also going to spend a bit of time towards the end of the session talking about the areas of the syllabus that students tend to find a little bit more challenging before moving into a Q&A session. I'm going to be here throughout, working behind the scenes to answer as many questions as I can. Please note that we can't guarantee responding to everybody directly, either verbally or via the web chat, but we hope that the questions we put to Aileen at the end that we share in our Q&A discussion will be helpful to everybody. And if you'd like to answer a question, please click on the Q&A button and submit it there. Okay, that's all the introductions done. So at that point, I'd like to hand over to Aileen and we can get started. Thanks, Aileen.
Thanks very much, Lucy. Hello, everybody. Thank you very much for joining us today. Before I get started going through the agenda that Lucy's just outlined, I'll just give you a bit of more background around me, as Lucy's already indicated. I've been a professional accountancy exam lecturer, marker and examiner for over 12 years, and I work with several of the UK's professional accounting bodies, including ACCA, as well as a number of ACCA's approved learning providers as well. And I specialise in tax, although I do also have experience in some of the other subject areas as well. And I provide support to students generally around exam technique, use of CBE in exams, as also training fellow tutors as well. And I'm here today to really help you in passing your tax exam, and I hope that you will find today's session useful. So let's get started on the actual contents for today's session. And the focus, as Lucy outlined, is going to be primarily around looking at the changes in the Finance Act for the exam sessions running from June 2021 through to March 22. So as you'll know, there is a new Finance Act each year. Sometimes we've even had more than one in a year. And this is the main piece of legislation that drives the different tax rates and rules that individuals and businesses in the UK need to adhere to. So from your point of view as a student, why does it matter? Well, we need to update the tax exam syllabus every year to take into account the changes that come through from those Finance Acts. That means an updated set of tax tables that will be available to you in the exam. It means an updated syllabus document, updated technical articles in key areas, and updated specimen exam papers and practice papers that you can access on ACCA's practice platform, and updated course materials, practice questions as well from your tuition provider. So there's an awful lot of work goes into all of that. Now, the good news from your point of view is actually this year that we're moving into now, Finance Act 2020, is not actually too bad a year for changes. So I want to try and put your mind at rest there. Most of the rates and thresholds for income tax have remained the same. For example, the personal allowance is still £12,500. And the basic rate and higher rate thresholds are still the same as they were. All of the VAT rates remain the same for exam purposes, as do most of the rates around inheritance tax as well. So that's the good news. There are still quite a lot of rate changes and a few name changes as well, and a few new areas to consider. And so that's why we're running this session for you today. So let's start off with one of the biggest parts of the tax syllabus, as you'll be aware, income tax. So the key figures then to watch out for that have changed for this Finance Act 2020 that's going to apply to any exams between June 21 through to March 22. Home workers, so people who are required to work at home by their employer, they can now claim £6 per week instead of £4 per week for the additional costs like heating and lighting from working from home. Many people have become a bit more interested in this particular benefit in the past year or so due to the increased amount of home working that's been going on due to the global pandemic. In regards to pensions, we see that the pension lifetime allowance has increased to £1,073,100 and the minimum annual allowance has reduced down to £4,000. But both of these figures are available to you in the tax tables in the exam, so you don't need to worry about memorising these. The rules around how they actually apply remain the same. Now let's think about employee benefits. The percentages that you would need to use to work out car benefits are now more focused on electric and hybrid cars. And so you'll definitely want to practice a lot of these types of questions so that you're prepared for how to use the information that's available to you in the tax tables on these. You'll only get a question in the exam that examines the new thresholds and not any previous rules, therefore. So all cars are assumed to have been registered from the 6th of April 2020 onwards in the exam. There's also been slight increases in the car fuel benefit rate and the van and van fuel benefits as well. But again, they're available to you in the tax rates in your tax tables in the exam. So you really don't need to worry about those kinds of changes because you would look them up quickly in your exam anyway to double check the figure there. The official rate of interest, which we use in those employer-provided living accommodation and beneficial loan calculations for employee benefits, that's now reduced to 2.25%, but you can find that rate on your tax tables. Now, if you're looking at a property income question for an individual and the landlord has suffered some finance costs in connection with a residential property, then now none of the finance costs can be deducted by an individual in their rental income calculations for that residential property. 100% of the finance costs are now given as a basic rate tax reducer, so we deduct it from the bottom of the income tax computation. But do watch out because this is not the case for a company and it's not the case for an individual who's renting out a commercial property. So you do actually have a bit of information in the tax tables around this, but I do think you're going to have to practice some questions in order to really understand exactly how the tax relief is given in each different scenario and making sure that you're comfortable with spotting when this tax reducer way of getting tax relief on finance costs to do with property, how they get that, what circumstances those apply in. So it's only if it's an individual and only if it's a residential property. Now let's move on and talk about capital allowances. Now most of capital allowances is actually staying exactly the same this year. In reality, in the real world, there has actually been a change in the amount of annual investment allowance, and that was changed part of the way through the year. But for your exam purposes, you are just going to assume that the annual investment allowance, AIA, remains at £1 million throughout the period that you're looking at. Okay, so that is has been set out by ACCA, by the exam team, that only the £1 million AIA is examinable for this year. But there is a new capital allowance for you to study, and it's called Structures and Buildings Allowances, or SBA. So we're going to spend a bit of time looking at this as it hasn't been examined before this year. So SBA then is for expenditure on new commercial structures and buildings, on or after the 6th of April 2020 or the 1st of April 2020 if you're looking at a company situation. So this is going to include things like offices, shops, factories, bridges, tunnels, and so on. These are the types of things that ordinarily don't qualify for plant and machinery allowances, as you know. The building or structure needs to be being used for trade purposes or property letting in order to qualify, but you need to be careful to exclude a number of costs from some of the figures you might be given in the exam. So, for example, you need to exclude the cost of any associated land, because you can't get, land can't qualify for SBA. You also need to watch out for any costs or associated fees to do with the purchase and any stamp duty. And other complications to watch out for as well is whether somebody is using part of the property for residential purposes, and therefore you want to restrict the proportion that is qualifying for the SBA there. If a question doesn't explicitly mention the construction of a structure or building, then you're just going to assume the SBA is not relevant in the question. So in other words, it's just a normal purchase of a building which was already in existence, because SBAs is very much focused on new commercial structures and buildings. So it's not about residential properties, and it's not about ones that already exist that you might be buying as a business owner. So the rate itself is 3%, which is in your tax tables. It's a straight line, writing down allowance, and it applies for 33 1/3 years. So you're going to have to remember that part of it, but the 3% is in your tax tables. So a little bit more on this then, thinking about how you might deal with the types of issues in the exam around this. I've mentioned some of the complications already around SBAs. So in terms of approaching your answer, you want to treat each building or structure separately if there's more than one in the question. And you would want to treat it separately as well to any plant and machinery allowances that you are calculating. So SBAs does not impact on your plant and machinery calculations. You would do them as normal and get your allowances figure from that, and then you would look at what qualifies for SBA separately. But when you're looking at deducting the amount for capital allowances away from your trading profits, you would put any plant and machinery allowances together with any SBAs and deduct that from your trading profits. Things to watch out for then. Watch out for any accounting periods that are more or less than 12 months long, as you'll need to prorate the allowance. So for example, if you had a 6-month period, the rate would be 3% multiplied by 6/12, because that 3% is actually for an annual period, for a 12-month long period. Furthermore, if the building structure was bought or if the building or structure was bought or disposed of during the period that you're looking at, unlike what we have with plant and machinery allowances, we have to prorate the SBA. And the allowance can only be claimed from when the building or structure is actually brought into qualifying use, so when it starts being used for trade purposes. So you would be told that date in the question, so you would need to just be careful that you're not picking the date that they bought the building or structure, or they bought it from a developer, or they constructed it themselves. It's not that date, it's the date that it was brought into qualifying use as part of the trade. That's the date that you can start claiming. So that's quite different to what we have for our plant and machinery allowances, where it doesn't matter when in the period you actually make the purchase, you get the full period's worth of allowance. That's not the case with SBAs. Another difference to plant and machinery allowances is the fact that there's no balancing adjustment on the disposal of the assets. So instead what we do is we adjust the capital gain or loss made on the disposal by adding the SBA claim to the proceeds of the seller. And the new owner then of the building or structure then takes over any remaining allowances for the remainder of the 33 1/3 years. the writing down allowance that the new owner though takes on, they will always still go back to the original cost of the asset and claim that 3% on that figure. So I'm going to show you an example of this in a short video now, because I think actually seeing some numbers is going to help you understand how this, all these rules can apply. This isn't an exam standard question, it's more one just to show you how some of these concepts can be applied to a scenario. So I'm going to play the video. It might just take a few seconds for it to start automatically, so there might be a little bit of a delay, so just be aware of that, and then we'll move on to the next area that we want to discuss. So I'm using the Test-Reach practice platform in this question then to show you how to approach a question using Structures and Buildings Allowance, SBA. So this is new for Finance Act 2020, and it's for certain qualifying expenditure on things like offices, factories, retail premises, bridges, tunnels, etc. And first example we've got here is Sophia, who prepares her sole trader accounts to the end of March every year. On the 1st of August 2020, she bought a newly constructed factory from a builder for £550,000, which included land valued at £60,000. And she brought the factory into use in her business on the 1st of December 2020. And we're being asked to calculate the tax impact of the purchase of the factory for the years ended 31st of March 2021 and 31 March 2022. So looking at this then, we are dealing with capital allowance. So it's going to be part of our calculation to get to the profit figure for this individual. We need to get to the right capital allowances figure. We may have also been doing some plant and machinery calculations. This structures and buildings allowance calculation sits quite separately to the other capital allowances calculations. So it doesn't go into any general pool or any special rate pool or anything like that. It's completely separate. The calculation itself is relatively straightforward, but you do have to watch out for a couple of tricky elements to it, including the fact that here we have got somebody who has bought this factory on the 1st of August, but doesn't start using it in their business until the 1st of December. And structures and buildings allowance is different to plant and machinery allowances in that you do time apportion the allowance depending on when it was bought during the period, and that is very different to what we do for plant and machinery allowances. So that means that we're being asked to think about the year ends 31st March 2021 and the following year. So let's look at the years one at a time. We've got the year ended the 31st of March 2021 first of all. So let's consider what happens there. So that's the period in which we actually purchase the factory. So the factory qualifies for the structures and buildings allowance, but what you need to watch out for is the value you're going to use, because you've got a couple of figures here. You've got 550,000 paid to the builder, but within that was £60,000 to do with land. And when we're working out the qualifying cost for our structures and buildings allowance, we do not include things like land. So we want to take that out. So we're going to take the £550,000, deduct from that the 60,000 that's to do with the land, and that gives us a figure then of 490,000. Now from that we want to actually work out the allowance amount. So structures and buildings allowance is worked out at a flat rate of 3% per year, but we're going to restrict the amount that can be claimed in this particular period because the factory was only bought part of the way through the period. Not only was it only bought part of the way through the period, but they didn't actually start using it in the business until the 1st of December 2020. So that means we're actually only going to give 4 months worth of the allowance in that period, only from the 1st of December 2020 until the 31st of March 2021. So that's 4 months. So that works out to be £4,900. So that's the amount that can be claimed for the Structures and Buildings allowance for the year ended 31st of March 2021, and that would then be deducted along with any plant and machinery allowances from the trading profits for Sophia. If we move on then to look at the next period, 31st of March 2022, we are doing our SBA again that year, 3% rate. This time we're not going to restrict it at all because we only do that in the year of acquisition and also in the year of disposal, which is the other thing to watch out for that is different to plant and machinery allowances. So for the periods in between, we just take the 3%. And that means we're doing 3%, and we always go back to that initial qualifying cost figure. So we take the 3% from the £490,000 figure. So each year you will go back to that original qualifying cost. And that works out to be then £14,700 for that year. So that's your Structures and Buildings allowance deduction for the year ended 31st of March 2022. Now in question 2 here we've got a bit of an extension to this. We've got Sophia selling the factory then on the 31st of July 2022 to Ang for £700,000, including land valued at £80,000. Ang brought the factory into use in his business on the 1st of August 2022 and makes up his accounts to the 31st of March every year. And again, we're asked to consider what the impact then is of the disposal of the factory on both Sophia and Ang's tax affairs for the tax year 2022-23. So things to consider here then. From Sophia's point of view, she is disposing of the factory. And different to plant and machinery allowances, when we are disposing of a structure or a building, there is no balancing adjustment in the period of the disposal. Instead, what happens is that the purchaser will continue to claim the remaining periods for that building. In the final period for the seller, they will proportion how much of that period they had the factory for in this case, and they will claim that proportion of the SBA. So it's very different to what we have for our plant and machinery allowances. So we'll look at Sophia first of all. So from Sophia's perspective then, she's got her accounts to the end of March every year. So for the year ended the 31st of March 2023, she's going to be claiming her SBA based on that 3% rate multiplied by the original qualifying expenditure amount of 490,000, and we're going to multiply that by the number of months that it's been used by her in that period. So that's going to be 4/12. And that gives us a figure of 4,900 rather. So we'll pop that in here. So that's what she's going to claim for that last period that she's got the factory for. If we look at things then from Ang's point of view, Ang has the same year-end date, so March 2023. And Ang is just going to pick up the proportion that hasn't been claimed. So 490,000 at 3% multiplied by 8/12. So that's going to be £9,800. So that's how much Ang will claim then for that factory in that particular period. And then we'll carry on over the next years until that 33 and a third year period has finished. Now there's another consequence to think about here as well. It's important to consider. And that's the fact that Sophia has sold this factory. And actually SBAs have an impact on the chargeable gain that you would work out on the disposal. So that's another element that you need to consider and put into your answer, potentially. So from Sophia's point of view, the proceeds for the disposal of the factory were £700,000. So we take the proceeds figure of 700,000 and we deduct from that. We'll deduct from that the cost, but before we do that, we're going to add in all of the SBAs that she would have claimed over the time that she owned that factory. So in our case, in our example, we had a 4-month period initially, then we had a full year, and then we had this 4-month period again when she disposed of the property. So that's an amount of 4,900, another amount of 4,900 at the end, and a full year's worth of 14,700 in between. So in total then, that's £24,500. So adding that together then, we get an amount of £724,500. We're going to deduct from that the original cost, which was 550,000. And that leads us then to a chargeable gain of £174,500. Now you'll notice in that we included the land. So when you're actually working out SBAs, you exclude the amount of land. But when you're then dealing with somebody who has disposed of a property that has been subject to SBAs, then you include the land in your calculation.
I just was keeping an eye on the Q&A box, and we've actually had 2 or 3 questions on that video, so I thought maybe it would make sense to pause and look at them. If you look in the inbox, there are 3 questions at the top specifically about that video, and I thought it would be sensible to tackle them now, if that's okay.
Yeah, let me just have a wee look at those. Okay, so I'll go in reverse order from what I'm looking at anyway. So we've got a question about, in question 2, why don't you deduct the value of the land in question 2? So in that question, what we were sorry, I'm just trying to get the question up for myself so I can see it again. So we don't So we deduct the value of the land when we're looking at working out the amount for SBAs, but when you're moving on to looking at the actual gain calculation that you do when somebody has disposed of a property, that isn't impacted. All we're doing is we're adding in the amount of the SBAs that has been claimed, but land is still part of the normal calculation for capital gains purposes. We're not changing that part of the capital gains calculation. We're just adding in the fact that they have claimed some SBAs over the period. So the land bit, the excluding of the land, is the only place where that impacts in the whole of it, is working out the actual amount on which you work out SBAs. That's where we pull out the land. But your actual gains calculation, when they dispose of it further down the line, that isn't impacted by that. So I think that's where that confusion is coming around. And I think then, yep, so Ang, yep. Next question we've got, so can Ang only claim on the amount that Sophia paid for it? Yes, that's correct. So we always go back to the original cost. So remember, SBAs is only for newly constructed structures. So that very first cost of it is what is always going back. So that 3% is always on that figure. So that figure, less the lands, less any associated costs, is always that figure that we go back to, yes. Even when it's a subsequent owner of the business. Okay, so that's that one. Let me just work. Sorry, I'm just reading them. Just give me a wee second while I just read these questions. All good questions. Thank you for asking them. For Ang's calculation, we need to use the actual cost instead of the proceeds, which is the cost for Ang. So is that, I'm not sure if you're meaning then when Ang then subsequently will get rid of the property. Not sure. Let me just, not sure exactly what you're meaning by that one. So let me just, I think probably between you all, I think you're asking to cover most of the main things actually with it, the complications that come up. Somebody's asking if we can go back to the calculation. Not actually just the way we've got it set up, but the session is being recorded, so you will be able to go back and have a look at it again in the recording and pause it at that point and kind of use that as a bit of a practice. So you'll get sent information about that. And then I'm just going to pick another couple because we need to move on to the next question. But let me just pick up on a couple of other ones that just cover slightly different points. So Amy's asked a question about, does the 33 and it's a 33 and a third years, not 33 and a half, the 33 and a third years period start again with Ang? No, it does not. So that's a really good question. The building or structure has a 33 and a third year period in which it can claim, somebody can claim SBAs, whether that be the original person or another owner down the line. So each of them has to pick up on the remaining amount. So that's information that when the actual transaction happens between each of them, the accountants will be clarifying the information, and HMRC will need to know that somebody else is now the owner of that property and is going to take over the claim of the remaining 33 and a third years. So perfect. Okay, so I think that probably covers enough of the different elements from that question, because I see quite a few of you asking sort of similar things. So the recording will be available and you can go back and have a look at it again after the session. So you can go back and listen again as I work my way through it as well. So thank you very much for your questions on that. And what I'll do now is I'll just get going on to the next part that we're going to look at, next part of syllabus changes, which is around national insurance contributions. And here, really, for national insurance, you will use your tax tables a lot to help you with national insurance questions. There's a lot of information there for you to use and you don't need to memorise. So there have been some changes in the numbers that are on those tax tables. So for example, there's increases in the lower thresholds, and they are now different for employers and employees class 1 NIC, although the upper threshold remains the same at £50,000. Because now we've got this difference between the lower thresholds, so we've now got 8,788 and 9,500 respectively, you want to be really careful when you're reading the question exactly what you're being asked to work out. Are you being asked to work out employers class 1 NIC or employees class 1 NIC? Because we now have different lower thresholds for those, so you need to pick up on that. Whereas before they were the same, and therefore you didn't need to perhaps be as careful with which one it was. Class 2 NIC has increased slightly to £3 and 5 pence a week, and there has also been an increase in the small profits threshold as well. Again, both of those are on your tax tables, so just get used to looking up your tax tables when you're doing practice questions and covering the material using the tax tables, because that's what you're going to have available to you in the exam. So that's what you want to start getting used to. The employment allowance that is deducted against national insurance of an employer is £4,000 now rather than £3,000, which it was before. And it's now only applicable where employers class 1 NIC liability for the previous tax year was less than £100,000. So do just watch out for that little tricky part there. Moving on then to talk about capital gains. Firstly, we've got a couple of name changes just to be aware of if you come across this in any material or resources. Just be aware that Entrepreneurs Relief is now called Business Asset Disposal Relief, which is a little bit more of a mouthful. And Principal Private Residence Relief, which we would have summarised to be PPR before, is now called Private Residence Relief. So now you might just see a reference to PRR instead, meaning the same thing. So that's a very minor name change, but I thought it was worth flagging up to you because you might come across it in material, updated notes and technical articles, for example, and might just be worrying that that's something totally brand new. So a couple of name changes there to just watch out for. The limit for claiming business asset disposal relief over an individual's lifetime is now £1 million, but investors relief still has that limit of 10 million. So just watch out because there's now a difference between the lifetime limits for those two reliefs, whereas they used to be the same. But again, this is on your tax tables, so you can just double check that with the updated tax tables from ACCA's website. A couple of important changes to talk through in property income. So for private residence relief then, PRR, for an individual, instead of the last 18 months of ownership being counted as occupation, that's now been restricted to 9 months. So it's now the last 9 months of ownership of the property that counts as occupation, whether the owner is there or not. So that's one thing to watch out for. And the other thing is around letting relief, which is now completely different in terms of when it applies. Because now you need to have shared occupancy with the owner and tenant, and it isn't applicable therefore for a trade or a business. The same calculations though are done for letting relief as you might have covered previously. So in terms of comparing the amount of PRR to the period, to the letting period is the same when we're looking at that cap of 40,000. Remember, there was a maximum amount of 40,000 as well that you could claim for it. Those are the same. So the actual determining of how much you can claim is the same, but the scenarios to which it applies are completely different. So this is definitely an area that you want to do some question practice on. So I've actually got another short video just to show you which works through an example of that. But just before we do have a look at that video, I just want to cover one little point on inheritance tax, because the only thing that's changed with inheritance tax really is that the residence nil rate bands has now increased to £175,000 rather than the £150,000 that it was previously. So that's just the one thing on inheritance tax to watch out for. So let's look at this letting relief scenario then. So I've got an example, another video. Again, there might be a slight delay before it loads up for you, so just be aware of that, and then we'll just watch that video, and then after that we're going to just start looking at a couple of more challenging areas from the tax syllabus as well, and then pick up on questions. So in this question I've got for you here, we are looking at an individual who has bought a house on the 6th of April 2006 for £200,000, and Rio sold the house on the 31st of August 2020 for £500,000. So as soon as you see that, you should be thinking, you know, what tax is this that I'm getting tested on? It's capital gains tax. It's an individual, they have an asset that they've bought and then sold. And you can see down at the requirements here, we're asked to calculate the gain arising on the disposal of Rio's house. We're given some more information here as well. We're told that during the whole period of ownership, Rio lived in the house while renting out 2 of the rooms to tenants, and that amounted to a total of 30% of the whole house. So this means that when Rio sells this house, the whole amount of any gain is not necessarily exempt. You've got a private residence relief rule where if you own a property and you live in it the whole time that you own it, and then you sell the property and you make a gain on it, that gain will be exempt under the private residence relief rules. Now this is just the same as what you would have studied under a previous Finance Act if you have done that already, if you're resitting. However, what is completely different now, if you have studied tax before, is that the way we treat the fact that there is some letting happening during the period that Rio owns that property, that is completely different the way that it's treated now. So what we have now under the Finance Act 20 is that where any part of a residence isn't occupied by the owner for residential purposes, and so that includes this situation here where we've got Rio who has part of the house rented out to tenants while he lives in it, then the private residence relief exemption will be proportionately withdrawn, proportionately to the amount that is rented out to other people. And what's different, what's completely different to what rules we had before, if you studied tax previously under a different Finance Act, is that letting relief was when the owner of the property was away from the property and they rented it out while they were away working overseas, or they were living in another house, or they were travelling, anything like that. For whatever reason, if they rented out their house, they were able to claim letting relief while they were away from that house if they were renting it out. Now, under Finance Act 20, is completely different. And instead what we have is that the owner has to have joint occupancy with the tenants. So completely different. So this example I'm going to work through for you so you can see how we actually deal with it. So I'm going to use the spreadsheet function in the practice area. This is just the practice area in the practice platform where you can just go in and you get a blank practice area, and it's really useful to use this if you're practicing any questions that you have access to, even if you were actually just using paper questions, but you want to actually be practicing on the software that you're going to be using in the exam. So you could sit with your paper question beside you and you could be putting your answer into the actual practice platform. So I really recommend you do this. So I'm going to do this to just show you how I would lay it out. So we're asked to work out the gain arising on the disposal of Rio's house. So we would start off with our proceeds. Our proceeds are £500,000. And then we take away the cost, proceeds less cost, 200,000. We can underline that. And then we have the gain before private residence relief. And you can see we can move our columns to give ourselves more space for the labels. And then that's 300,000. Now you could, if you wanted to, use the sum function. So for that you need to have, instead of brackets, you need to put the minus sign in front of your figure, and then you can put in sum, and then the brackets, and then just cover the cells that you want included in your sum, close brackets, and then you get your answer. But if I was to do 500,000 and I had to put in 200,000 and then I did the same sum, what we find is it doesn't work. Okay, so that's just something to watch out for, is that if you're in the habit of putting brackets like I am when I do mine, I'm in the habit of putting brackets because that's how I write out all my answers, then it's not going to work. So you want to make sure you're using the minus sign at the start. Okay, so we've got 300,000 as our gain before the PRR. Then we go on and work out what the PRR would be. Now, had he not actually rented out the rooms, then the PRR would have covered the whole of the gain. We wouldn't even need to actually work this out because we would just state that it was covered fully because it's his only residence and he was occupying it the whole time and he didn't rent it out. But as he did rent out some of the rooms, we're not going to allow the full exemption. So instead what we're going to do is take the 300,000 gain and we're going to multiply that by the proportion of the property that is actually used by the owner. So 70% of the property is used by Rio, so 300,000 of the gain, the 300,000 gain is multiplied by the 70%, and that gives us 210,000. So that's the PRR that you can claim. You can claim private residence relief of 210,000 to reduce that gain down. And it reduces down to 90,000. But because he has had shared occupancy with tenants, he can also claim letting relief. Now the rules for getting the letting relief are completely different now under Finance Act 2020, but the mechanics of applying the relief is the same as what you may have studied under previous Finance Act. So you still look at three figures. You're going to look at the actual amount of the private residence relief, which was 210,000. You're going to look at the gain that is attributable. You can see my typing's not the best. Gain attributable to the letting period, to the letting of the home rather. So let's just make that a bit wider so we can see that. So the gain that's attributable to the letting of the property is about the proportion of the property that is rented. And that's 30% of the whole house is rented. So we're going to take the gain before any relief, and we're going to multiply that by the proportion that is rented out of the property, which was 30%. Which means the gain attributable to letting of the property is 90,000. And the last figure that we compare to is 40,000. Because that is the maximum amount of letting relief that you can ever get. You can't get more than 40,000 as a deduction. So it's the lower of these three figures. So the lower of the three figures is the 40,000. So we're going to deduct 40,000 from the 90,000 to get a final gain figure then for this property of £50,000. So a couple of things just to watch out for there that may come up in questions is if you ended up in potentially a loss situation at the bottom of your calculation, letting relief cannot convert a gain into an allowable loss, so you would just be reducing that gain down to 0. Another thing to watch out for in exams is if we did have a period where the owner of the property was away from the property and was renting it out, then that would qualify for private residence relief, so letting relief wouldn't be relevant in that case. Letting relief now has to have joint occupancy between the owner and the tenant. So at the same time they have to be there. So letting relief doesn't apply where the owner moves out and rents out the whole of the property. Alright, so hopefully you found that useful. I did see a couple of questions on it, but I think I probably answered that question right at the end there with the last thing that I said in the video, which was just to clarify that yes, you absolutely do need to have actual occupancy. You need to be living there at the same time as the tenants. So somebody was asking, well, what if you were overseas and you were renting out your property? Is that right that you can't claim letting relief now? And that is correct, yes. So it's quite a big change then to what we had before, certainly. So yes, that is correct. Your understanding is correct there. Okay. So before we get on to a couple of the trickier areas that come up in taxation, I wanted just to clarify a couple of things around some current affairs that are affecting tax in the real world, and therefore is that relevant for your exams. So one of the things is Brexit and the impact of that. The main area that in your tax exam that could be affected by that would be VAT, but for this coming year certainly anyway, we are just assuming that EU acquisitions just carry on and just continue to apply, and also that any temporary changes that were brought about because of COVID-19, so there were things like there were reduced rates of VAT for certain things like hospitality, industry, and also there were some deferrals of payments on account and VAT payments as well that were allowed in the UK, and none of those are examinable, so you are not expected to have any knowledge of those. You will just assume that the businesses or individuals in your exam did not take advantage of any of these reductions or deferrals or anything like that. So I just thought it was worth just clarifying that in case anybody was a wee bit concerned as to whether they would need to know about those kind of things. So then I want to move on to talking about a couple of challenging topics that we see coming up in the tax syllabus, and that, as we know from students sitting the exam, and if you read through any of the examiner's reports, which I really recommend that you do, you will see some more challenging areas that students find more difficult perhaps in the exam coming up and being mentioned there. So you really want to make sure you're reading those reports to get a bit of a flavour for that. One of the areas that I certainly hear students asking about is corporation tax groups. So I thought we would just spend a few minutes just doing a bit of a summary of some of the key points around that. So we'll start off looking at group relief groups, and then we'll talk about the chargeable gains groups. Students can get quite muddled on these because we have two totally different group situations that could arise, but they do have some similar sounding rules and advantages to them, but they are actually quite different. So let's look at 75% group relief groups first of all. So this is where we have our parent company and its 75% subsidiaries. Now that might be directly, so company A owns 80% of company B, and therefore company A and B would be in a group relief group together, or it could be indirectly. So it could be that company A owns 80% of company B, and company B in turn owns 95% of company C. So indirectly then, if you were to multiply that 80% shareholding by 95%, you get the indirect shareholding that A has in C. And that actually works out to be 76%. So all three companies then could be in a group relief group together, and that means that they can share losses between them. So the first thing to do then is to establish which companies are in the group. And for this, we include companies that are not UK resident. But when it comes to actually sharing the losses out between the companies in your group, non-UK resident companies can't take part. But we do include them in the group because we want our group to be as big as possible. And that gives us then the greatest amount of options around the different ways we can share the losses. So by including a non-UK resident company, it might give us access to one of its UK resident subsidiaries. So that's why we do it. Group loss relief then, if you are doing group relief, it's set against taxable total profits, TTP, of the company. So it means after QCDs have been deducted. So that is different, therefore, to what we see for other loss relief claims for the current year. When you're deciding how much of a loss can be shared between the different companies, you need to watch out for situations where the companies have different accounting end dates, or if a company has joined the group or left the group during the accounting period, because both of those scenarios mean that you have to be really careful about how much of the loss is passed from one company to another, because we can only pass the losses of the current year. So we can only pass where they have a common accounting period. Once you have established the maximum amount that can be shared between one company and another, one of the big advantages of group relief is that you can actually choose any amount up to that maximum that you want to relieve. So that's a real tax advantage. That's a good tax planning advantage for a company. Also, you don't have to make a group relief claim. It is optional. So if other uses of a loss would be more beneficial, then the company can choose to do that. So in the exam situation, you want to first of all consider whether they should surrender their losses, and if so, which companies would it be most beneficial to give those losses to. The second type of group that you might come across then is the chargeable gains group. And again, it involves a 75% relationship between companies, but you need to be careful as it's not in the same way as we've just seen for group relief groups. Instead, what we're looking for is a link of at least 75% between a parent company and its subsidiary, and so on down the chain. But we need to check that there's an indirect relationship of more than 50% between the top company in the chain and the bottom one for them all to be included in a chargeable gains group. So if we had company A at the top, that's the parent company, and it's got a 75% shareholding in company B, who in turn has a 75% shareholding in company C, who in turn has a 75% shareholding in company D, then we need to decide which ones are going to be in a chargeable gains group together. We need to not only check that there's a 75% link at least between each company at each stage, we need to check from the top company down to the bottom company, is there at least 51% shareholding from top to bottom, as in does company A at the top have more than 50% of the shares indirectly with the company at the bottom, which in that example I've just given you is company D. So you multiply the shareholdings. So company A has 75% in company B, which has 75% in C. So you multiply 75% by 75%, and that comes out at a 56% indirect shareholding, so that's fine. And then if you multiply it then by what C has in D, which was 75% of the shares again, that brings you down to 42%. We're now below the 50% mark. So company D does not have enough of a relationship with company A for them to be included in the same chargeable gains group. So in that scenario, A, B and C would be in a chargeable gains group together, but D wouldn't be in that same group. Like for group relief, we only UK companies can participate in this, but we want to include overseas companies because it gives us access to perhaps another UK company. Tricky areas to watch out for with chargeable gains groups include the fact that rollover relief can be claimed by one member even though it's another company that in the group that has purchased a qualifying asset. And the key advantage of being in a chargeable gains group is that the assets are transferred. Any assets that they buy and sell between companies in the group are transferred at no gain, no loss. So it doesn't trigger a tax charge. And the businesses can also then make claims to transfer gains and losses between each other as well. So even without actually transferring any physical assets, they can transfer gains and losses between themselves because it might be that they as a group can overall save tax that way. So you want to spend some time on this area doing some question practice, and there's also a really good article on the ACCA website, technical article on groups that I strongly recommend that you have a look at. Oh, I'm just reading a little message here from Lucy, just saying she can't see the last set of bullet points. I just want to double check. Can anybody see that? If you could just let me know if you can see that one. It's fine.
Yeah,
good.
I can see it all now. Thanks, Aileen.
That's good. I just wanted to double check that you could all still see that. That's brilliant. Okay, so I mentioned the examiner's report is really useful for helping you spot which areas tend to come up that students find more challenging, and those are definitely ones that you want to make sure that you're spending a lot of time practicing past paper exam questions on. The second and last challenging topic that I just want to chat through with you is on residency, which I know from experience that students can really get themselves tied up in knots around the residency rules. So I wanted to just quickly do a bit of a review of them. You do have some information in the tax tables, but not all of this information is in your tax table, so it is something that you are going to have to spend time on and memorising. And again, the more question practice you do, the better for that. So there is an approach to take. If you have a situation where somebody is not in the UK the whole of the time, they spend some time overseas and they're in the UK sometimes, there is a correct process to follow to try and figure out, because what you want to know is this person resident in the UK? Because if they're resident in the UK, it's going to impact on tax calculations because HMRC will want to tax them on all of their worldwide income. So are they resident in the UK? First thing you want to check is automatic non-UK resident tests. That is the first place you go. And there are three things you can check. Any one of these three would lead that person to be automatically non-UK resident, and that's you. You don't bother looking at the other tests. So any of the three things of they spend less than 16 days in the tax year in the UK, or they spend less than 46 days, but they've not been a UK resident in any of the last 3 years, or they have spent less than 91 days in the UK in the tax year that you're looking at, and they work full-time overseas. So any one of those three, doesn't matter. If just one of them applies, tick against one of them, they are an automatic non-UK resident, and that's you stop with the tests. If none of those do apply, you then move on to the next level of the test, which is the automatic UK resident tests. And again, we have three possible scenarios. Any one of these will make them automatically a UK resident test, but don't look at these, or don't remember these, don't think about them until you've been through the automatic non-UK resident test first. That's where students get into a muddle with it. So they'll be automatically UK resident if they're in the UK for 183 days in the tax year, or they only have a home in the UK, or they work full-time in the UK. Any one of those three situations will make them automatically UK resident. Now, if you have gone through the automatic non-UK tests and nothing applied, and you went through the automatic UK resident test and nothing applied, only then do you worry about the sufficient ties tests, which you're going to have to memorise, which are, do they have close family in the UK? So by that we mean a spouse, a civil partner, or a minor child. Or do they have accommodation in the UK that they've used in the tax year? Do they do substantive work in the UK? In the last 2 tax years, in either year, have they spent more than 90 days in the UK, or do they spend more time in the UK than they do anywhere else? And you're going to go through all 5 of those and count up how many apply. And then you'll go and look at what's in the tax tables. So you do have a lot to memorise, but it's really important that you do it in that strict order. And don't try and leap straight into an automatic UK residence test, because that's where you're going to make mistakes. So you do have some information in the tax tables in the exam, but not what I've got here on this screen for you. You will need to memorise these. Okay, so it is a tricky area. Lots of question practice on this is going to help you, and remembering this specific order to go through the material that you're working through in the question on. Okay. So the last thing I want to talk about before we move on to the Q&A session, pick up on any questions that you've got, are all the fantastic resources that are available to you on the ACCA website, and I'm going to just point you to look at these. So if you haven't already read the Finance Act 20 article, please do go and read it. It's got lots of fantastic worked examples. So some of the things that we were covering today in the changes, you're going to find some worked examples there. You'll find worked examples of other areas as well, where there's been some slight rate changes, etc. as well. Fantastic, really, really good article. So make sure you go find that. It's in the technical articles part of the tax page. There you will also find a higher skills article, which is relevant to the 10-mark question in section C. So please make sure you have read that as well, because it gives you lots of good scenarios that might come up in an exam situation for that particular question. So make sure that you read that as well. Lots of other technical articles in there as well you want to make sure you've read. There's ones on cars and all the different ways they come up across the whole of the syllabus. Inheritance tax, adjustment of profits, groups I mentioned already, so there's lots of good technical articles there. On a separate page within the tax resources, you will find the examinable documents, which is the tax tables that you have available to you in the exam. So please make sure that you are familiar with what will be available to you in the exam, and that you start practicing using them sooner rather than later, because that's what you're going to have in the exam, and you want to be able to very quickly find your way through the material and know where inheritance tax is, and be able to skip to that page of it quickly in the exam. So if you haven't already, I do strongly recommend, as part of your study plan, you build in all of the technical articles, the Finance Act 20 article, the Higher Skills article, and also make sure you start using the tax tables. Rather than going to your own notes, you won't have your own notes in the exam, you will have the tax tables. So start using them sooner rather than later. And then that opens us up for Q&As.
Brilliant, thank you, Aileen. That's been an incredibly useful session so far. So thank you very, very much for that. Before we go into some of the questions sort of more related to the exam, specifically the examples you've shown, etc., I just wanted to pick back up on what you were saying about the resources, so on your previous slide. So firstly, just to tell everybody watching that the links to the resources that Aileen has talked about in some detail there are all within the resources section of this webinar, so you don't need to go yourself to the ACCA website and try to hunt for them. We've given you all the direct links so you can access those easily from today's session. Aileen, we had one or two questions coming through just asking how important are the technical articles really. So I was wondering if you could just give your thoughts on, you know, whether that how important that is in the scope of a student's preparation. Where do the technical articles fall? You know, what weight should they add to those? And then particularly also the examiner report, which I have included the examiner report link in this webinar resources section as well. It's not something we've particularly called out. So I was wondering if you could maybe spend a couple of minutes talking about the value students can get from that resource too.
Yeah, absolutely. Yeah, the technical articles are really great. There's not an overwhelming amount of them, which is actually a good thing because it just focuses students in and it makes it more achievable that they'll get through them all. But absolutely, sometimes I get asked, well, which ones should I read? You should read them all, absolutely. You can read them all. And where the most appropriate places I find for students to slot them into their study plan is, first of all, go on and have a look at what there is available. So as I say, there is one on cars, there's one on groups, there is one on inheritance tax, there's a couple around income tax as well. So as you get to the end of that block of your revision or your studying, so once you've covered all of income tax, go on and have a look and see which articles are relevant to that block of study. And they're fantastic because they give you more worked examples, which is great to see the explanation of a topic alongside the worked examples. They also highlight areas where, from the examiner's experience, students have tended to make mistakes or get confused in the exams about them. So they are absolutely a priceless resource and absolutely free for students to access on ACCA's website. So absolutely do them all, slot them in at the relevant points in your studying once you've finished that topic. And I would definitely recommend coming back to them again as part of the revision phase as well and read them again. Absolutely. Examiners' reports, yep. As I mentioned, they are brilliant at pulling out areas where students have struggled in past exams, and they also give lots of good exam technique tips as well for students, so I thoroughly recommend that people go and read those. What to do is start with the most recent one that's available and work your way backwards in time. So, and you'll probably see, I think, once students have read maybe 3 or 4 of them, they'll start to see some common themes coming through. And then it would be great if they could start thinking, how does that apply to their own studies and practice, and how they're applying their knowledge to questions. Are you making any of those same mistakes yourself? Do you recognise yourself in any of the comments? And then you hopefully then are going to pick up on that in the exam and not fall into the same kind of mistakes. So they're absolutely brilliant. They do also have example questions in them as well. So again, it's just another way of seeing some more exam standard questions, which is always absolutely valuable for students to see as many as possible. So yeah, definitely put it in your study plan, everybody.
Excellent, thank you, Aileen. Right, I'm going to just turn to the questions that we've been receiving then throughout the session. And first of all, before we get into maybe some of the more technical specific ones, I just wanted to cover some slightly more general questions that we've had that we actually get a lot for, during webinars that we run for any of our exams really. So I think they're really worth sharing. So we had one towards the beginning of the session actually from a student who has failed marginally in the past. That actually sounds like they were so close with 49, and they're just asking what kind of preparation tips would you recommend for somebody in their position who's been ever so close on a previous sitting.
Oh, I know, it's absolutely heartbreaking. I know when somebody gets so close. The positive to take from it, and I know sometimes that can be really hard to find positives in it, but the positive to take from that is that you've got enough knowledge to pass. Without a doubt, if you're getting into the 40s, you have enough knowledge. Now, there may be one or two syllabus areas that you absolutely need to go back and look at because maybe you're making too many errors in those areas, but you have enough of a foundation there. It's probably exam technique that's the issue, so it may be that you have run out of time and didn't answer all of the questions. It may be that you are not reading the requirements as carefully as you need to and you're just missing. And it could be that you've just missed one little comment at the end of a requirement in section C that tells you to also state the date that something is due. And that would be enough to get you across that pass mark. So exam technique is probably the thing to focus on there. I would definitely never recommend that somebody who's sitting in the 40s with a previous attempt goes back and starts studying from scratch again and goes back to module 1 of their material and works their way through. You do have base knowledge. You now want to use question practice, as much exam standard question practice as possible, and work your way backwards. Identify from doing those questions which mistakes you're making, which areas you need to go back and look at the material again for. You do not need to start from the beginning. That's the main thing people worry about, is that I don't know enough. I need to just learn some more. It's actually, you need to learn how to apply the knowledge you've got confidently and accurately in the exam. I think that's what will make the difference to anybody in that situation, and I absolutely sympathise with anybody in that situation.
Fantastic, thank you, Aileen. I hope for those of you listening who are in that position, I hope that is reassuring for you. I was going to say this is a related question. It's not exactly a related question, but we've got somebody asking whether, is there kind of one or more fundamental principles that if you didn't get it would lead you to failing the tax exam? Is there something they should really, is a key thing they need to be focusing on?
Do you know, there's 100 marks available and you're only looking for 50 of them. I know that might feel like, a lot, but it means you can actually make quite a lot of mistakes. And please be reassured that the markers, if you make one mistake, okay, so fair enough, in your objective test questions, there's nothing you can do about it. You're going to lose the 2 marks. But in your section C questions, if you make a mistake in, say it's an adjustment of profits, for example, and you add something back when it should have been deducted, well, you're going to lose the half mark or 1 mark that was available for that line of the calculation. But the marker has to recalculate everything you do after that in the answer. And if it applies the principles correctly, but albeit to the wrong number, after that, you'll get all the rest of the marks if you've done everything else correctly. So, that's one thing to flag up. And the other thing about kind of key topics, you absolutely cannot question spot in these exams, but what you can do is be aware of where the bulk of the syllabus sits. So you know that you've got a 15-mark income tax question in the exam. You know you're going to have a 15-mark corporation tax question in the exam. And also those areas can be covered and are covered in section A, definitely. We see that coming through, and sometimes also in section B. So it will be throughout the whole exam. So those are your 2 biggest areas in terms of the syllabus and where the questions are coming up in terms of the number of marks. You want to go into the exam being really confident with your income tax and corporation tax computations, but what I don't want students to think is that it's about expecting that in their exam they are going to have an income tax computation and a corporation tax computation to do, because if you have a look at past papers, you don't see that come up every diet at all. These are such big areas and they're 15-mark questions, so there's so many different elements that can be examined in slightly different ways. So you do need to know those computations, absolutely, but you need to be comfortable. It's almost like jumping into the computation halfway through, picking apart one element, like you might just have to do an employment income calculation, even though that's just one part of a full income tax computation. So those are the kind of the biggest topics, but things around admin, you know, those could be the 2 marks that make a difference between a pass and a fail. So you absolutely need to cover the whole syllabus, but weight your studying time on the areas of the syllabus that have more of a weighting in the exam, definitely. Hope that answers that question.
Okay, brilliant. Thanks, Aileen. I've got one more kind of preparation related question that I'm going to ask you, and then I'm going to invite you to have a look through for some of the more technical questions to see which ones you want to take. So this last question is, so it's kind of 2 related questions. One student asking how much time should they give themselves for the revision phase, and another student basically saying if they haven't actually started now, if they haven't started yet and they're due to be taking the exam in June, what would a good strategy be for them?
Okay, well, so ideally, in an ideal world, 4 weeks of revision is pretty much standard across most of the tuition providers, that we allow that kind of 4-week lead-in period before the exam for revision. Now, I don't want anyone to panic thinking there's no way that I'm going to be ready for, you know, the start of May in order to be ready for those June exams. But that's kind of the ideal scenario. That is more than enough time as long as you're using your revision phase, you know, strategically focusing on exam questions, focusing on technical articles and that kind of thing. I know a lot of students do like to wait until they get the results perhaps of a previous exam before, you know, deciding, yes, right, I'm going to go to the next sitting because I don't have a resit to do. It does make your window quite short. So if you haven't already studied, now everybody knows their own individual situation best. If you're a full-time student, then you know, you've got what I think we're now at, I think 5 or 6 weeks before the exam. You have enough time, if you're a full-time student, to cover the tax syllabus. It is a big syllabus, but there is actually a lot of repetition once we get on to looking at corporation tax versus what you would have already covered at income tax. So you'll probably get through it'll take a while to get through the first part of the syllabus with income tax, but actually getting through the remaining taxes doesn't take as long. So it is possible. If you are a full-time worker and you also have a family, I think you're going to find that really tough. I'll be totally honest with you. It doesn't mean it's not doable, because everybody knows their own learning style best. They know what kind of student they are. They know if they can get up early in the morning before everybody else is awake or before they go to work to get some done. And if you are in that situation and you do have a lot of other stuff going on, I would definitely say little and often. Don't leave it 1 or 2 days and not have done anything for your exam. Even if it is just read a technical article, read the Finance Act article, have a look at a webinar debrief of a question, you know, just do something every day. So those would be my kind of my viewpoint on it. But everybody's situation is different, and don't compare yourself to what somebody else was able to achieve in 2 weeks before the exam. Everybody's different.
Okay, perfect. Thanks, Aileen. We've got about 5 minutes left. If you'd like to go into the Q&A area and look in the For Aileen folder and have a look through there and just pick a few questions that you think would be valuable to share. And whilst you're doing that, I'm just going to give the audience a reminder of a few different things, just give you a moment to review those questions. So Lots of you have been asking whether you're going to be able to access this webinar again, and the answer is yes. So you'll receive an email tomorrow with details of how you can watch it again, and that will be available up until the exam session, so you'll be able to go into it as many times as you want if there's anything you want to recap. And we'd really encourage you to do that and make the most of it. Just also to let you know that we have added, since the beginning of the session, we've added a PDF of the webinar slides, which contained lots of valuable information, to the resources section of the webinar. So if you refresh your screen, if you can't see it at the moment, refresh your screen and you should then see that PDF, and you can download that and refer to that again at your convenience. And then last thing from me, a few people have been asking whether we'd recommend, whether you can basically use your study materials from the last exam year, or whether you should get updated materials. Now, we would always recommend that you get updated study materials if that's at all possible for you. If you're in a position where that's not possible, then please make sure that you're making use of sessions like this and making sure that you read the most recent articles, just to sort of supplement the materials that you do have. But just again, we would strongly recommend you get access to the new study materials if that's an option for you. Okay, that's the reminders from me. Aileen, I'll hand back to you for the last few questions.
Okay, I will just try and get through as many of them as I can as quickly as possible. Okay, just starting with a question from Hannah. In the objective test questions, if you've got 2 answers for one question, if you get one wrong, you'll still receive 1 of the marks. No objective test questions, it's either all correct or it's all wrong. So you get 2 marks or you get 0. Then we have a question from Letitia about, do we still have to know the formulas of the basic rate limits? So for example, if you had a pension and you were grossing up to extend the basic rate and the higher rate bands, yes, you still need to know that. Yep. Atia, for COVID-19 deferral, students just need to assume that the taxpayer has not deferred them. That is correct. Yes. Noyonika, you have asked, in section C, are we expected to also include the working notes on the Excel sheets? Yes. Absolutely. You want in case you have made a mistake, you need to show your marker what you've done. Now be careful though, if you're only asked to calculate something and not explain, you don't need to give big, lengthy notes explaining why you have done what you've done, but you need to show the working. So if you have made a mistake, the marker can actually give you partial credit. Let's see, just another couple. I'm just aware that we're close to the end. Maria, you've asked, we've got a starting rate of 0% applying to savings income where it falls within the first 5,000 of taxable income. That is correct. I mentioned something about a decrease to 4,000. That was on something completely different. It wasn't about the starting rate of savings income. There's 2 things that you might have picked up on that are 4,000. There is the minimum amount for the pensions allowance, and also the allowance for the national insurance, employer's allowance for national insurance. Both of those were a 4,000 figure, so that might be just what you were picking up from there. Carney, you've asked for group relief. Non-UK companies are included in the group, but losses are only transferred to UK companies. Is that correct? That is correct, yes. Salome, you've asked, where did the 40,000 come from? I presume that was in the property income question. The 40,000 is always, the 40,000 is always 40,000 for anybody's situation. That is the maximum amount of letting relief that anybody can claim, is 40,000. And so I think that's us just up to the time. And I think I've covered as many of those as I could get through.
No, thank you, Aileen. You've gone through quite a lot of them, so that's brilliant. Thank you. And we are just over time now, so we will have to bring the session to an end. I hope that you have all got something from this webinar. I think it was extremely useful, and a huge thank you, Aileen, for taking us through all of that information. I know I said it just a couple of minutes ago, but you will receive an email tomorrow with details of how you can listen to the session again, and we'd really encourage you to do so if you have the time. So thank you again, Aileen. Thanks to all of you for attending, taking the time to join us, and for all your questions. And we're wishing you the best of luck in your exams. Thanks, everybody.